Good morning, everyone. David Moore with IRA Advantage. Thank you for joining us today. Today's presentation is a 1-hour version of the Self-Directed IRA Bootcamp. And we've got a lot of information to get through as usual, and I just really appreciate you coming to join us. If you are not currently on our newsletter list, I'd encourage you to sign up for that. You can reach out to Seymour, C-M-O-O-R-E at IRAadvantage.net, and she can get you on our email list. You'll be aware of, obviously, you're aware of the presentations and you're here today, but any other changes in laws or news that we've got going out, we put out things monthly. Also, if you've got questions on different topics, whether it's 1031, whether it's even something along the lines of a life insurance contract, even those things, charitable remainder trusts, all kinds of different topics. You can take a look at our YouTube channels, I guess I should say. One's for Equity Advantage, 1031exchange.com, and one is for IRA Advantage, and it covers the IRA stuff. But I'd like to say that there's no such thing as a dumb question. So if you've got questions, we will probably be sailing through this presentation. If I have a chance, I'll address them. But if I don't get to them during the presentation, we will be replying to any questions you've got after the fact. You will also be receiving a hard copy of this. Actually, I shouldn't say hard copy, an electronic copy of the presentation if you like, and so you can get you that stuff too. One last bit of housekeeping: if you happen to be a real estate broker in Oregon, these classes are all approved for continuing education for you as well. So if that's something you'd like, please reach out and we're happy to accommodate you in that. So I really enjoy these classes. I enjoy this topic. It's something that's sort of a very well-kept secret, and it's our job to open up that secret. So this is not new information. It's something that's been possible since the inception of retirement accounts. It's just something that's just not very often done. And obviously, with days or weeks like we're having right now, today is May of 2022, and we've had a pretty rough couple of weeks on Wall Street. So people typically in inflationary times look to hard assets. We all hear the advertisements for gold, silver, whatever it is, precious metals. Real estate, I would say, is the ultimate tangible asset. But this class is going to talk about what you can do with it, what you can do with an IRA or 401k plan. And we're probably not going to get into the deep details of how to get things done. We're going to give you the direction on how we are actually going to be preparing the investment vehicle. We don't sell investments or give investment advice. We're just going to give you an investment vehicle that's going to allow you to go buy what you want to buy. So, and as I said, this is not something new. The rules on what an IRA or 401k can buy have never changed. So from the mid-70s, everything we're talking about today has been possible. It's just a very well-kept secret. So we will hit the ground running right now, and hopefully you guys are going to get some good nuggets of knowledge out of this presentation. And as I said, only dumb questions one you don't ask. If you've got questions, please don't hesitate to reach out. So as I said, this is not new, all right? A self-directed IRA is not a legally defined term. It's just a term that describes an account that allows you to go buy what you want to buy. And it's always been possible, and really it's pretty much wide open with respect to what you can buy. I mean, unless something specifically prohibited, it's therefore allowed. And most of the time, so my background was investment real estate, and I had an exchange company with my brother. We founded it in 1991, so it's over 31 years old at this point in time. And what happened during the ensuing years after we put the company together, people kept coming to us and asking, hey, I understand we can take our IRA 401k and go buy real estate. How do you do that? And so we ended up working through the process, figuring out what was going to be needed. And what was frustrating to me is I'd go to a class on this stuff. I'd sit there all day long, and really all I'd learn is how to make the investment that sponsor was trying to sell me. They didn't teach me how to actually do what I wanted to do. So I want to stress that we're in a situation here where we're just providing the investment vehicle. We're not giving investment advice. We're just going to listen to what you have today and where you want to be in 2, 5, or 10 years. And we're going to help you, create a vehicle that's going to allow you to get there. And what's interesting during times of healthy, the economy's moving along, bumping along well, this side of the business typically slows down because Wall Street's singing along and people really aren't looking to diversify. And that's really what we're talking about, diversification. Any financial advisor is going to tell you the best secret of success is diversification. But my interest was actually giving our investors more opportunity to take their money and go out and buy more real estate was the initial, the intent of this. And then during the years, we've had a lot of different things. We do what's called rollover business startups, where we're literally creating a business structure that allows you to buy the franchise world figure this out, buy a business and work for it. So that's sort of the lifeline. During the last crash, we did lots of rollover business startups for people that maybe been displaced. And honestly, through COVID, sort of same thing has happened in different situations too. But it's really rarely a question whether you can or can't do something. It's how we're going to get you there. And as I said, our intent was just to give people that further opportunity. And ultimately, it's all about diversification, which, as I said, is the ultimate secret to success. So as I said, we all hear the ads. We hear people talking about self-directed accounts, and if I'm sitting in front of a room, and that's the one thing I do miss about doing webinars, is that I don't get to see you guys, your smiling faces out there, and see whether or not I can't read your eyes or anything. So I'm just sitting here talking to a screen. So I sort of miss that. Well, I definitely miss that. But it's just fun to be able to get the information out. But when we look at these accounts, by law, a retirement account can literally buy, an IRA can buy anything other than collectibles, life insurance contracts, or stock in a sub-S corporation. So rarely is the investment a problem. What causes problems is transactions between or for the benefit of a disqualified party. If we look at diversification, typically if you talk to somebody in the Wall Street world about diversifying, you want to go out and buy real estate, they're going to sell you a REIT. Okay, that's what's possible. That's what's in the wheelhouse. But the reality is you can take a 401k plan and go buy property. You can go buy gold. You can go buy crypto. All of these things are possible with an IRA or a 401k plan. And it's just really, truly a question of who's actually, taking care of that account for you. So it's one of those things it's pretty easy. It's not a difficult thing to do. It's just something where the information's not readily available, and we're going to be that information source for you. So I said it's simple, right? If I'm handling, so yesterday I did a presentation on 1031s. When I look at a 1031 exchange, I look at 4 issues. 1, it's got to be an exchange. 2, what's given received have to be of like kind. 3, we need to go across or up in value and equity between the relinquished and the replacement property. And then finally, we've got to have, what we say, continuity of vesting. So, in the 1031 world, we're really in a situation where it's pretty simple there, but there's 4 issues. Got to be an exchange, got to be like kind, got to go across or up in value and equity, got to have continuity of vesting. If we're looking at the IRA world, it's a totally different thing. We're really in a situation where we're only looking at these 2 issues. What do you want to buy? And who are you going to transact between or for the benefit of? And it's literally that easy. So an IRA can buy anything other than collectibles, life insurance contracts, or stock in a sub-S corporation. A 401k plan can buy literally anything other than collectibles. So it's even more liberal, even more wide open. So rarely is the investment a problem. What triggers problems for people is transactions between or for the benefit of a disqualified party. So who's a disqualified party? Well, your lineal ascendants, descendants, their spouses, or any legal entity owned and controlling interest by one of those. Those would be disqualified parties. Now, I didn't say anything about siblings, aunts, uncles, cousins, and I think that's sort of interesting because if I was looking at 1031, for example, related party transactions, we've got some restrictions, and related parties in the 1031 context would include those, people, at least the siblings. Where in the IRA world, IRA 401k world, siblings are not disqualified parties, nor are aunts, uncles, cousins, and really think about the fact that if you came to me and said, hey, you know, little Susie's going to college and I want to buy Susie an apartment to live in during the time, you know, my daughter Susie's going to college and I want to use my IRA, I can't do that transaction because Susie would be a disqualified party as a kid. Now, if Susie's your sister, that would be okay. You want to buy a condominium for mom to live in. You can't do that because your mom's a disqualified party to your retirement account. Okay, as would be, like I said, you and your spouse too. Now, what's interesting is you can't transact between or for the benefit of a disqualified party, but you can transact along with a disqualified party. So, David, what do you mean by that? Well, I'll tell you what I mean by that. That means that if you wanted to combine personal money and IRA or 401k money into a common investment, you can do that, all right? You just can't sell to, buy from, loan to, or borrow from. You can't work on those properties. Like I said, you couldn't buy a condo for mom to live in. But you just look at these two factors. This is what's important. It's not complicated. What do you want to buy and who are you going to transact between or for the benefit of? That's what it comes down to. Now, I want to stress something, that if you've got Wall Street accounts, that those things, you can make a poor investment, but it's really pretty much impossible for you to commit a prohibited transaction. In the self-directed world, there's no guardrails, so you've got to be prepared. You've got to make sure you're very, very diligent to make sure you're doing the right things with a checkbook IRA or solo 401k, because you literally have the power of the pen. You can go do whatever investment you want with a pen stroke. So it's critical that anytime you look at that account, you think, okay, what am I buying and who am I, you know, transacting between or for the benefit of? Those two issues. And as long as you're not committing a prohibited transaction, you know, some benefit to a disqualified party or transaction between a disqualified party, rarely is the investment itself going to be a problem. So you go in and you start talking to your financial advisor, you talk to your attorney, you talk to your accountant, you say, hey, you know what, I want to go out and do the self-directed account. I want to do these things. What kind of objections do you have? What would you run up against? And these objections are things, you know, I've been handling, like I said, tax-deferred exchanges for over 31 years. I've been handling these accounts about 15 years now. And these are things that come up regularly. So if you go to your financial advisor or somebody in that tax and legal world and say, gee, I want to take my IRA or 401k and go out and buy real estate, they might say, well, you don't want to do that because you're going to lose the long-term capital gains tax consequences of the sale of a long-term held piece of property. Well, that's true. But there's nothing you buy with your retirement account that's going to give you that long-term capital gains tax consequence, you know, that benefit there. So really, it's entirely a moot point. You should be looking at that account and say, okay, what's the highest, best use for that money? What's going to give me the best, safest retirement I can possibly get, and use the money for that thing. Okay, don't worry about whether it gives you short or long-term capital gains tax consequences on you know, at the end of the day, because there's nothing in your IRA that's going to give you long-term capital gains tax rates. So if you ask me, David, am I better off if I can only buy a piece of property, let's say, with money out of my pocket or with my retirement account? I can only do one or the other. I'm going to tell you, take the money out of your pocket. Okay, because now you've got, obviously you've got long-term capital gains. You hold the thing long enough, you can work on the properties. At the end of the day, you can kick the ball down the road using tax-deferred exchanges. It doesn't have any requirements with debt, all these other issues that are there. So once again, if you can only use one or the other, then I'd say take the money out of your pocket. But once again, we're talking about an IRA or 401k plan. That's your money. Okay, sometimes I think people lose sight of that, but it's your money. Use it as you want to use it. Use it for the highest, best use you can. And, you know, why not look at further diversification? And when we're talking about a truly self-directed account, I hear ads all the time from, you know, some major Wall Street firm talking about a self-directed account. Those are not self-directed accounts. Those are accounts that are going to allow you to make an investment based upon their menu of investment options. They're not going to allow you to go out and buy, that gold. They're not going to allow you to go buy the crypto. They're not going to allow you to go buy that piece of property that you want to, acquire with your IRA or 401k. So when we're talking about a truly self-directed account, it's going to allow you legally to buy any investment the law allows. And as I said earlier, those restrictions are very, very small. So the second objection that comes up, well, why would you take your retirement account, go buy real estate with it because you can't leverage that investment? Totally incorrect. It's just got to be non-recourse IRA 401k compliant debt. Now, what do I mean by that? Well, let me back up a second. When your retirement account buys something, okay, you're not taking money out of the retirement account to make that investment. All right, all we're doing is shifting. If it's an IRA, we're going to shift from a trust company that doesn't allow you to do what you want to one that does. And then if we do a checkbook IRA, we're just sticking what's called an IRA specific limited liability company between the trust company and the ultimate investment. If we do a solo 401k plan, you're literally going to have a bank account in the plan's name and EIN. Typically, our client is going to be the trustee of the account, therefore signer on that bank account. So you literally write a check to make those investments. And as I said, there's no guardrail there, but it's not an all or nothing situation, okay? You don't have to move all of your money into this new account. You just move what you want to use in the self-directed capacity if we're talking IRAs. Now with a 401k, I'd say let's move it all in the new plan. And we'll talk about the difference between IRAs and 401k plans in a bit. But, it's not all or nothing, and you're just going to use what you want to use it for, right? It's your money, invest in what you know. And the thing is with Wall Street stuff, if you invest in something you've got specific knowledge on, unless you're a politician, you got to worry about insider trading, right? You've got issues there. Well, if you're a mortgage broker and you want to take your retirement account and go make hard money loans, you can do that. If you're a real estate broker, you want to take your money and go out and invest in real estate, you can do that. So I would hope that you're going to be better at it than the average person. You've got some, additional education in that space. Why not use it? It's just the best thing you can do. It's a safe investment for you. But I want to stress this is typically going to be diversification. The secret of success is diversification, right? So we're just going to, I would say with an IRA, keep your Wall Street stuff where it is, only move what you want to use. And with a 401k, I'd say move it all in the new plan, then reestablish the investment accounts in your 401k plan's name and tax ID number. But when we're looking at non-recourse debt, what that means is that in a foreclosure, the only thing the bank can do is take that asset. They can't go after you for anything else. I tell people, think of this money as Susie's, all right? You wouldn't take and sign Susie's loan. You wouldn't take Susie's money. You start thinking, hey, it's my money, my thing. I think you've got an opportunity to go off the rails on it. So really focus on, and we take it to this extreme. When you come up with let's say we're doing a checkbook IRA for you, and we ask you for prospective names for the limited liability company, a lot of times people, first thing they do is use their name, something LLC. Well, we don't want to see that. We don't want to see IRA in it either. We don't want your name in it because I want it painfully clear that anytime you look at that checkbook, or if you've got a debit card for that account, you look at that thing and you know it's not you, okay? You've got to know that because, think about, you've got a debit card for your checkbook IRA, you drive through McDonald's and $10 later, you just blew up your entire IRA because that's the consequence of a prohibited transaction with an IRA. That's how important this is, okay? If you commit a prohibited transaction with an IRA, all funds in the account are treated as dispersed and distributed as of the first day in the year in which the indiscretion occurred. So you don't want to do that. The 401k plan, it's only the money involved with indiscretion. So when you're coming up with a name, we want you to have fun with the name, come up with a name that means something to you, but every time you look at it, you say, hey, this is not me, this is my retirement account, therefore you're going to be much less likely to have an opportunity to commit that prohibited transaction. So we're not pulling money out of the account. We're just shifting, like I said, if it's an IRA from trust company A to trust company B, if it's a 401k plan, we're just moving from plan A to plan B. Maybe we'll just look at the plan. Your current plan might allow you to make the investments that you want to do. That happens fairly often, but the administrator or trustee often won't want to do those. Maybe a piece of property, for example, because it's a lot more complicated to actually do their jobs with that thing. So it's quite possible your plan it currently allows it. Even the trustee doesn't know it. If it doesn't allow it, we can amend the plan to allow it. If we can't amend the plan, we'll just replace the plan. But we'll talk a little bit more about the 401k plans in a while. So can't be leveraged, totally wrong, got to be non-recourse debt. And the other thing about the non-recourse debt is this thing is not attributable to your income, your credit, anything else, because it's not your money, it's not your account, it's your retirement accounts that's actually the borrower in this situation. So like I said, in a default, they can take the asset, they can't take anything else. All right. What about RMD? So real estate typically is not considered something that's liquid. Okay. Wall Street, liquid, right? And that adds to the volatility of it, up, down, all that stuff happening all the time, because you just, hey, call your broker, sell, buy, sell, buy, whatever's going on there. Instant, easy. Okay, so the deal is when you hit 72 years old, remember, I just said 72, it used to be 70 and a half, but when you hit 72, you have to start taking money out. That's that RMD, required minimum distribution. Now you can start taking money out at 59, okay, or 59 and a half. So you can start pulling stuff out then, but you have to start taking out at 72. So we're looking at, and as we get older, quite honestly, it's more, I'm more concerned with getting money out than putting money in, right? But the RMDs, the issue that you'll hear people object to is, hey, you go out and buy real estate with your IRA, and now you're 72 and you've got to take an RMD, and there's no money to take the RMD. Well, you're going to have a penalty. Well, an easy solution, I think it's actually a wonderful opportunity. It's not a solution to a problem. I think it's a great opportunity, is taking things out in kind. So what do I mean by that? And like if we look at the RMDs, for example, you're going to look at the value, the entire value of what's in that thing, and it's going to be sliced up by the life table for that year, and that's what's going to generate your required minimum distribution. If we're looking at in the traditional context, you're just going to have it, money, maybe it's a wire or a check that's coming out of your account as that distribution, but there's nothing stating that it's got to be a cash distribution. So a lot of times our clients will end up taking in-kind distributions, and that's the solution to this RMD problem, because if you buy a property, let's say, and it's owned by your IRA or your 401k plan, and you say, gee, I really like that property, I really want to own it, or maybe you buy a place at the beach with it, and you've been treating it as an investment property and renting it to other people for all these years, and you're thinking, hey, that's a wonderful place, I love the property, I want to retire into it. You could do that, but you cannot use that property until it's been fully fully distributed to you. So the idea is you can take the entire property out at one time, and then you've taken all the equity out of that property, right? So you've taken a distribution of the entire equity in the property. So you're going to be facing a tax consequence. You took the property out. The nice thing is you can take it out if it's a checkbook IRA LLC, for example. You just do if that property is owned by an LLC, you just do an assignment membership interest to accommodate that distribution. If it's a direct ownership, you want to take it, let's say a deeded interest, you're just going to deed from the checkbook IRA over to you, or the 401k plan over to you, and now you've taken entire distribution of all the equity once again. There's a better solution though, all right? It's possible to actually discount distributions if it's a minority interest. So if you're looking at taking something out, maybe you take it out over 2, 3, 4 times, and each of those distributions is a minority interest. It might be possible, you work with your tax people, and it might be possible for you to discount the value of it by up to 40%. Now this thing is used, this discounting strategy is used all the time with gifting, all right? So in the 1031 biz, we'll buy a property, maybe somebody calls us up, says, hey, I've got 2, 3 kids. I want to ultimately give each of these kids a property, so I'm going to go exchange into these 3 properties, and then I gift them those properties over time. And each time they make a gift, if it's a minority interest, that recipient's got a minority interest, they have no control, therefore the value can be discounted by up to 40%. That same strategy can be used with in-kind distributions of minority interests, all right? So the other thing that might come up too, if you're taking an entire asset out, then you're looking at having to have an appraisal done. If you're taking pieces out, typically professional opinion of value would take care of it. So your broker should be able to provide you those numbers, and then you're going to give them to the tax people and figure out what the liability is. Now, like most things, anytime there's an upside, there's a downside someplace else. And the downside of an in-kind distribution is your incurring tax liability. If you take $10,000 cash out, you're going to lose, whatever you lose, four of it to tax, let's say. If you're taking an in-kind distribution, you're incurring tax liability without receiving the cash to pay the obligation. So you just got to be aware of that. And a lot of times when people pull an entire property out, what they'll do, the way they take care of that tax obligation is they'll do a cash out refinance of the property after it's gone into their name. And as soon as it's in their name, they no longer have that non-recourse debt situation, which, by the way, non-recourse debt, you're typically looking at 60-65% loan to value. You're looking at more expensive money, obviously. But as soon as they take it out, then they'll do the cash out refi. The refi money pays the tax obligation, and now they've got the property personally owned. So that's a great solution there. Finally, lose interest deductions, depreciation. Well, that's true. If the property's leveraged, though, let me just throw this out at you. If you've got a leveraged investment with the IRA or 401k, the 401k, there's no tax consequence on that debt component. But IRAs, even with the Roth IRA, if you've got non-recourse debt on the property, and let's say it's 50% loan to value, in the IRA world, you're going to have tax exposure on half the income. And if you sell the property at that loan to value, that LTV, you're going to have tax exposure on half the gain. So, probably 20, 25 years ago now, there was a gentleman that was really working hard in this space, in the IRA space, and I actually had him speak to our CCIM, Certified Commercial Investment Member. It's like the doctorate of commercial real estate. It's NAR's commercial division. But I had him come speak to the CCIM organization, and he was sort of pushing IRAs as an alternative to 1031. It's not. They're apples and oranges, two different things. And in fact, there are situations where an IRA might need to do a 1031 exchange. And an example of which would be if you've got a leveraged investment with the IRA, because as I said, if it's 50% loan to value, you're going to have tax exposure on the income or gain attributable to other people's money. So half the income would have tax exposure with an IRA. And if you sold the property with that same debt, half the gain would be taxable. So you've got to be aware of that, and it might be possible, or you might have to do an exchange even for, let's say, even a Roth IRA, for example. So don't just think, well, hey, I've got a Roth IRA, I never have any exposure. Another situation where you might have tax exposure, unrelated business taxable income, UBTI, is you're going to have it on that leveraged investment, and typically you're not going to have interest deductions, depreciation. But if we've got a leveraged investment, maybe your tax people are going to work with you to mitigate the tax exposure on that UBTI by taking interest deductions and depreciation on the thing. But normally what we're looking at, in the taxed world, you pull money out of your pocket. In the taxed world, we're always looking at basis and gain, and that's the whole point of 1031. In the IRA 401k world, we're not looking at basis and gain. We're just looking at value. What's in that account at some point has to come out. How do we get it out with the least possible tax consequence? And that bottom bullet there, lose interest deductions, depreciation, really, once again, it's a moot point, because name something you're going to get with a retirement account that's going to give you those. So I hear the argument. It doesn't matter, because it just, there's nothing there that's going to give you those things. Maybe once again, if you had a choice of pulling money out of your pocket to go buy the property versus the qualified money to buy it, if you could only do one or the other, you're better off with the money out of your pocket once again. But why not diversify? Why not take and do what everybody says is the best possible thing you can do, is diversify your retirement. Gives you stability. So we've talked a lot about a variety of different things right now so far, but why would you choose to do this? And I'll tell you, anytime Wall Street's going up and down, bouncing around, when it's singing along, our IRA 401k side of the business slows down for obvious reasons. When it starts stumbling, then the call volume and the transactions start adding up again. So, why do people call us? Why do they want to do these things? Well, one, they're tired of the stock market's roller coaster. Once again, that's really because of the nature of it, right? You've got that with a retirement account, you've got the ability to buy, sell things all the time. Everything's tax deferred. So, it's going to go swing, these big swings up or down. Now, you got tax money in Wall Street. it's been really tough, honestly for me the last month, because I'm sitting there watching my accounts. I can't go to cash, because I go to cash, I got to realize the gain, and I'm going to lose half of what I made on the stuff. So I'm sitting here watching it, and I got to hang on to it, and just go for the long term on it. But with IRAs and 401k plans, you can always go in and out of these things. All right. So tired of the stock market's roller coaster. Greater financial control. You literally put the money where you want it, right? So you've got the ability to buy, sell what you want with, when you want, without having to engage anybody to do this stuff. If it's a checkbook IRA or solo 401k, you literally do things as fast as you want to do them. Invest in what you know. We talked about that earlier. Why not do that? Okay, and really, I mean, we've got a situation right now with Wall Street where, unfortunately, politicians have put themselves in a different class than we're all in, and they can take advantage of insider, trading and everything else. And I'm not Martha Stewart's biggest fan, but why did Martha Stewart have such a problem when our senators and House representative people are doing this stuff all the time with no issues there? So that's not exactly a good thing. Increased investment flexibility. Like I said, you've got a broader spectrum, a broader menu of investment opportunities, and why not diversify? I mean, why not? If you want to be that bank for somebody, you can do that. And I guess my comment on money, making loans or being lien holders on properties, never anything but a first, and never for anything more than you'd like to own the property for. Just plan on default. That way you're not going to be surprised by something. All right. Real investments, not alternative investments. Real is capitalized because real is real. Okay, why is it that in the history of mankind we've got real estate, we've got precious metals? These are things that are the oldest investments known to mankind. And if you talk to a financial advisor and start talking about this stuff, these are called alternative investments, and they sound flimsy to me. Okay, I don't call them alternative investments. Like I said, they are real investments. Real estate is a real investment. Gold is a real investment. It's there, it's tangible. And anytime we're looking at inflationary periods, tangible assets is where people go. And like I said, real estate's the ultimate tangible asset, because we're not banking on it going up in value to make us money. I was taught never to bet on appreciation. It'll come, and I've got unfortunately a wonderful person that mentored me for years, and just a wonderful friend that's passed away. And he had two rules, and I said it yesterday in the presentation. I'll say it again today. His number one requirement for real estate investment success was, don't get yourself in a situation where you have to sell in a recession. Okay. If you don't have to do that, it's always going to be doing what you need to do. The second thing he had to say is, real estate's not a get rich, quick scheme. It's a get rich slowly but surely scheme. And once again, like, it's a tangible asset. You're not banking on appreciation. There's a variety of things happening during the time you own it that's going to give you a nice return there. So community-based investment. You want to do something locally where you know what's happening with people that you know. You can do that with a self-directed account. All right. You don't have to have the money halfway across the world doing something somewhere else. If you want to make a difference in your community, you can actually do that. Or you want to work with people in your community, you can actually do that, which is a wonderful situation. Take advantage of today's opportunities. Obviously, you see something happen, you can make those investments literally with a pen stroke in certain cases. And it's like an instantaneous, investment. So you can really take advantage of things as they are occurring. And like I said, it's about diversification. Today's opportunities. What's happening? Maybe obviously for the last decade, it's been hard to argue about Wall Street's what was happening there. It's been a great situation, and right now we're stumbling around a little bit, having some correction. Hopefully it's short-lived. But we're going to be right now we're looking at that real estate world's been thumping along, and obviously there's lots of pressure on it. Our 1031 business the last several years have been the best by far we've ever had, and this year we're probably 30% ahead of last year even. So it's really amazing to see what's happening there. But it's a flight to hard assets, inflationary hedges. Okay. Finally, security. What do I mean by that? Okay, so if you've got a checkbook IRA or a solo 401k, you've got the money literally where you want it. Okay, it's once again not with some financial firm halfway across the country. If you want to have a checkbook IRA and you have a bank regionally here that you want to work with, you're just going to have a bank account in the limited liability company's name and tax ID number. And if you've got solo 401k, you're just going to have a bank account in the 401k plan's name and EIN, and that the money is literally where you want it. So that's one of those things where people feel really good about. They like that it's not someplace else with people they don't know. It's literally where they want to put it. Possible investments. Now, we talked about this earlier, but I'm going to drill down once again with it. These are, unless the law specifically prohibits an investment, it's therefore allowed, right? So these are the sole exclusions: collectibles, life insurance contracts, stock in a subchapter S corporation. So the collectible deal, you know, I mean, collectible cars have been amazing investments for the last probably decade anyway, but you can't buy those things. So anything that's a collectible, and I'll say in precious metals, you've got to be careful. If you want to go buy gold, silver, palladium, whatever it might be, you've got to work with a broker that actually specializes in this, because collectible investments are not going to qualify. So collectible metals are not good enough. So typically, whether it qualifies or not is defined upon the purity of that metal. Alloy, for example. I can't buy life insurance contracts. I don't know people, I don't know if I've ever had anybody wanting to do that anyway. Can't buy into a stock in a subchapter S corporation. That was a problem for one of our clients actually this week, because this investment that was going to be made was in the form of an S corp, but rarely has had a problem. So you name it, your IRA or 401k probably can make those investments, and that's, you know, the bottom line is, one issue, you've got to be making these investments with the intent as an investment. All right. Now, if you're conducting business, you want to go out and flip properties with your IRA or 401k, it's not an investment. All right. If you're flipping properties with money out of your pocket, and you want to argue, you want to try to use 1031, you can't, because it's not property held for investment. Whether you want to argue that or not is you know, a whole different issue. But there's something called the Clarkowski court case, 9 points used to determine dealer status, and I use that court case obviously in the 1031 space for dealer status. I use that same court case, those 9 points, when I'm looking at you know, UBIT situations, for example. So if we're looking at conducting business, you're going to be subject to that UBTI, where if it's an investment, you're not going to be doing that. So flipping properties, once again, if you're going out conducting business with your retirement account, even with the Roth IRA, you're going to have tax exposure. If you're making an investment, you're not. An example, simple example might be you go out and buy an apartment building. It contains a laundromat. Okay, that's an investment. You go out and buy a laundromat, now you're conducting business. So two different things. It looks like the same, but it's not, right? Disqualified parties. So I said there's two issues. What are you going to buy? And second is, who are you transacting between or for the benefit of? So any transaction between or for the benefit of disqualified party, and we talked about this about 10 minutes ago, probably 20 minutes ago now. But you know, who's a disqualified party to your retirement account? Lineal ascendants, descendants, their spouses, or any legal entity owned in a controlling interest by one of those. All right. So we have to be careful in those situations. All right. You're a disqualified party to your retirement account. Now, another example of disqualified parties would be your IRA. Your traditional IRA is also a disqualified party to your Roth IRA. So those retirement accounts could be disqualified parties to one another. Now, you can't transact between or for the benefit of a disqualified party, but you can transact along with a disqualified party. So what do I mean by that? If you want to combine personal money and plan money into a common investment, you can do that. If you want to combine your traditional and your Roth funds into a common investment, you want to combine your account and your spouse's account into common investments, you can do all of those things. All right, we've got to be careful on what's happening. If we're using a tenancy in common structure, we want a tenancy in common agreement that's going to spell things out, how it all works. That TIC agreement is going to be just like an operating agreement for a limited liability company. If we're using IRAs, For example, checkbook IRA, like I said earlier, we're going to create a custodial account. We're going to create this IRA specific limited liability company. The operating agreement is specifically tailored to IRA investments. All right, you can't just go out and use not TurboTax, but legallaw.com or whatever it is. You're not going to get an operating agreement that's going to allow you to even open an account with that trust company. So you've got to be working with people. My position, and I haven't said this yet today, but anytime you're looking at whether we're talking 1031s, investing in real estate with that stuff, or you working in this space, you want to have great tax people. Okay, I think great tax people are probably the most important people in your life. You're going to pay people to help you get these things done. One of my pet peeves is I don't like to see, in the 1031 space, for example, I've had clients through the years where I get a legal invoice for $30,000 and for the legal bill, and really what happened is my people have been talking to the lawyer day and day. I mean, the lawyer calls us, basically they're being paid to learn. I don't want you to do that, okay? I want you to be working with people that understand the stuff and paying to get an opinion on something, not paying them to learn on your behalf. Sorry if you're a lawyer or a CPA out there, that's just the way I see it. And I've just had too many clients over too many years with too many big tax bills trying to figure this stuff out. So in this space, it's really important you're working with people that that understand stuff, and we're here to answer your questions. All right, the only dumb question is the one that's not asked. So you have questions, pick up the phone, give us a call. People really have an aversion to calling these days. They want to just email back and forth or even text. And it's really not a very efficient way of communicating. So this is complicated stuff. It deserves your attention. Give us a call. There's no cost to that consultation. Even if you're working with somebody else in the space, if you're not getting answers, give us a jingle. We're happy to go over it. So anyway, so what are you buying? Who are you transacting between or for the benefit of? Prohibited transactions. Examples of prohibited transactions: borrowing money from your IRA, you can't do that. Loaning money to your IRA, you cannot do that. Selling a property to your IRA or buying from your IRA, can't do that. Unreasonable compensation for management. I'm going to say there shouldn't be any compensation for management. That bullet's on there because of our legal counsel basically, well, gee, sweat equity, and I haven't said this yet, but sweat equity is not okay. If your IRA owns a property, your 401k owns a property, you cannot work on that property. I'm going to say it again, you cannot work on the property. If you do, that's a prohibited transaction. You're saying, well, gee, why shouldn't sweat equity be okay? And really, I agree with you. Why should not sweat equity be okay? Because you're increasing the value of the account without a corresponding expense. Ultimately, that's going to convert to the account being worth more, and therefore, ultimately, at the end of the day, it has to be pulled out, and the government's going to get more money because you have a better value in there, right? So the argument, the only justification I can see for why sweat equity is not okay is because they want the tax revenue from the vendors, right? So we have to battle for 1031s survival every so often. 1031's over 100 years old, but every few years we have to fight some government official decides, hey, we want to get rid of 1031. It's going to make us all this money. Well, no, it doesn't. It actually costs the government a lot of money, and I wish I'm really getting tired of trying to show them that. But you think about one real estate transaction, who gets paid out of that? Brokers get paid, title escrow people get paid, I get paid, finance people, property inspectors, appraisers, contractors, because when was a property ever sold where the buyer didn't improve it, right? So it's in the best interest of the government and everyone else to have market liquidity in real estate, because that liquidity keeps the property in a better stead. We can all see properties that people don't want. They don't have the money to take care of it, or maybe they're sitting on it because they don't know what else is out there. They feel trapped. They don't want to pay the tax. But that market velocity is what keeps things vibrant. So we want to help people move things, and that sweat equity component. Like I said, what would happen if you're putting the sweat equity into it? It is a prohibited transaction once again, but the only rationale I can see on why they don't want you to do that stuff is because the contractor's not paying normal income tax. All these different things that are happening the government's having to give up normal income tax for all those vendors, and that's the reason. But if you're trying to rationalize, why you couldn't do sweat equity, I can't rationalize it for you. So anyway, using your IRA security for a loan, you can't do that. Okay, it's got to be non-recourse debt on things. And by the way, if you were a joint owner of a property along with your IRA and you're saying, well, gee, the IRA, it's non-recourse to the IRA, it's only recourse to me. Well, no, you got the loan because you allowed the recourse to you, so you cannot do that. So once again, if you're a co-owner of a property along with your retirement account, you cannot have a recourse to you or any other disqualified party. It's just got to be non-recourse debt on that thing. Buying a property for personal use. Okay, you want to go out and buy a property. Maybe you've got a house and the lot, adjacent to your property comes on the market, and you think, well, hey, I want to buy that property with my retirement account, and pop the fence out, and I got a bigger backyard. Can't do that. Okay, you got a business. You want to buy the adjacent property, park equipment on it. Can't do that. There's a benefit to a disqualified party, therefore it's a prohibited transaction. So any of that personal use stuff. Now you said, David, gee, you said we could buy a retirement house. Well, I did say that. You cannot use that house in any way until it's taken fully as a distribution, though. All right. And the issue is, as I stated earlier, a prohibited transaction with an IRA means complete distribution of all funds in the account as of the first day in the year in which the indiscretion occurred. So we're talking about IRAs, checkbook IRAs. I'm going to say, once again, I'm going to stress, this is not an all or nothing transaction. I'm going to tell you, keep your Wall Street stuff with your financial advisor where you are. Only move what you want to use in the Wall Street world. Rarely in life is the easy way the right way for some reason, right? I mean, how often a shortcut end up taking you the long way? But if you look at these accounts, you've just got to make sure you plan things out. Plan it all out, ask the questions, figure it out, take the time to understand what you can and can't do. Understand that a prohibited transaction could occur this simply. All right, you go out and you say, okay, for example, we advertise on the radio, so we have people call up all the time. They call up and say, oh, well, hey, I heard your ad and I'm interested in buying this property, and we'll go through all the rules on how, what they can and can't do. And then the issue is it takes roughly a month these days to get an account established and get the LLC put together and get everything taken care of. So if you went out and tied up a property personally, you say, hey, the opportunity is now, because what happens, they call up, ask questions, and then I don't hear from them until they've got a property they have to have. And in today's market, if anyone's tried to buy anything lately, how long does it take to sell something if you're a seller, and how many bids are coming and everything else? You've got to have the ability to make this deal happen. And if you wait to find the deal and then you engage us to get it together, you're going to need earnest money well before this thing can be taken care of. And the fact you personally tie up the property would constitute a prohibited transaction. You can't personally tie up the property and then sign the purchase sale agreement over your retirement account. That would constitute a prohibited transaction. So if that happens, have a brother, sister, somebody that's not a disqualified party write the offer, take care of it, and then when your account's set to go, then we can make it happen. A better idea would be to get the account set up, ready to go, and then go find that thing. But it's just time, it's money, it's opportunity, and you've got to figure that out. But understand it takes some time to get this together. A prohibited transaction could happen as easily as you tying up a property personally and then assigning it over your retirement account. Now, I'm splitting hairs here. I'm being cautious. That's my job, is to be cautious. I don't want any of my clients to have problems, and that's why I go over this stuff. All right. And by the way, like I said, if we're talking IRAs, keep the Wall Street stuff where it is. Move what you want to use in this capacity. If you have spent all the money in the self-directed account to go buy the asset, now you've got tenants in there, the cash flow is coming in. It's not uncommon for our clients to go open a trading account in the LLC, in the checkbook IRA LLC's name and EIN, because that's an easy deal. You're just moving the money back and forth directly to the trust company. The downside of doing that is you're still talking one IRA account, therefore the prohibited transaction would then swallow all the Wall Street stuff that was owned by the IRA LLC. It's not going to encumber any of the money in the Wall Street account if it's a separate account, but if the account is in the checkbook IRA's name, the LLC, then we've got that that situation where it's encumbered. So we'll actually have people, even set up multiple self-directed accounts to isolate one account from the other if there's some more risky transaction that they're wanting to engage. So can I do this? Can I work on a property owned by a retirement account? No. You can manage it. You cannot work on it. So don't get dirty on it. It's what we say. Don't go out, pound nails, pull out the paintbrush, those things. Those are all going to constitute prohibited transactions. Can I guarantee a loan for my retirement account? Once again, the answer is no, you cannot do that. It's got to be totally non-recourse. It's got to stand on its own. The property is going to have to be able to support that loan. Like I said, it's going to be a lower loan to value, typically a higher interest rate. And most banks are going to require that they're going to want people, they don't want a borrower that's never owned real estate, right? They want borrowers that understand, have some investment background, understand what's going on. I'm going to tell you, make sure you've got enough to make the investment and cover any potential carrying costs until you've got money there to take care of any issues, because once in a while things pop up, right? Can my business occupy a building owned by a retirement account? So I get this question all the time. Hey, the building I'm in, I've been leasing, I want to go out and buy it using my retirement account. Cannot do that. All right, that would be a transaction between disqualified parties. You can make the investment in the building, but the fact your business is in the building constitutes a prohibited transaction because the business is a disqualified party to the retirement account. The only way to get that done is to create that rollover business startup, and that's like I said, a cumbersome process. But we're literally creating a new business that's going to be part owned by you, part owned by your retirement account, and that rollover business startup could be the owner of the building and the business. Can I write off expenses for travel? Okay, it's not your investment once again. So the answer is no. If your IRA or your 401k buys property in Kentucky and you live in California and you're flying back and forth and you want to write that trip off, you can't do it because it's not yours. As I said, it's Susie down the street that owns this thing. So your retirement accounts, the owner of the property, your retirement account's on the hook. If there's UBIT, that unrelated business taxable income, it's the one that's paying that. If there's, obviously, if it's real estate, you're going to have insurance policies. It can't just be an additional item on your homeowner's policy. It's got to be a new policy in the checkbook IRA LLC's name and tax ID number. If it's 401k, it's got to be in the 401k plan's name. Best, like I said earlier, the best way to look at anything owned by your retirement account is to consider it someone else's. So the cash flow on that property, I want to stress something. The cash flow off the investment is just going to go back into your retirement account, totally tax deferred. You're only going to have the tax exposure on distributions at the end of the day. So as far as real estate, we talked about buying an office building and that couldn't be done. So what kind of real estate would qualify? Rental houses, apartment buildings, office buildings, as long as you're not occupying them, retail centers, land, any real property acquired with the intent to hold for investment, even that future retirement home. You cannot buy a primary residence, a second home, a home for a disqualified party, or as I said just a moment ago, an office building to be used by a disqualified party. How do we do these? How do we create them? Okay, so all these plans can be rolled into a new checkbook IRA, or we can roll these things. If you lose a job, quit a job, it's possible to roll the money into this stuff. We've got to be careful when we're looking at retirement accounts, corporate plans, because if you're happily employed and you're under 59 and a half and you want to take the money to go do something, we cannot move that money. You'd have to quit your job to get access to those funds. I've had people quit their jobs. I've had owners step away from their business for a period of time to get access to that money. But I literally, before the last crash, we had a client that came to us, and he was working for a company that had a plan that wouldn't allow him to go to cash, and his little crystal ball told him the meltdown was going to happen. So he quit his job because he said he couldn't afford to work another 10 years if the market did what he thought it was going to do. He was right, and he had to literally quit to get access to that money. But any IRA can be self-directed. When we're talking about these other plans, it's age dependent, or if it's a previous employer plan, we can move that money. What about existing IRAs? Like I said, any IRA can be self-directed. How do we do this? Now, one of the first slides we talked about, it's very, very simple, all right? If you want to make a self-directed investment, your current trust company won't allow you to do it, you just move from custodian A to custodian B. It's an easy deal, all right? You can look up any number of, if you just type in, just go Google self-directed IRA, there's a whole bunch of trust companies out there. And we're not a trust company, okay? We, in the 1031 space, we are the conduit out of what you don't want into what you do want. We provide that 1031, that pipeline, the conduit out of what you don't want into what you do want. In the IRA 401k world, as I said earlier, we're not selling investments or giving investment advice. We're providing the investment vehicle. We're not a trust company. We're an IRA facilitator. Okay, and what we do with an IRA is we're either going to establish those accounts for you, or we're going to do checkbook IRAs for you. We'll talk about that a little bit more in a moment. If you're looking at 401k plans, and let's say you're self-employed, you're a real estate broker, self-employed with no employees, we're going to do a solo 401k for you. So we're going to provide the plan and the federal tax ID number for that plan. And we're obviously here to answer the questions. We want you to ask us questions. We want you to take advantage of our knowledge, our resources. We want to keep you going in the direction you want to go, because this is your retirement account, for goodness sake. And it's critical that you're doing the right thing from inception. But if you're working with us and you want to do a checkbook IRA, for example, you're just going to fill out a 2-page application. That application is really your just personal information, beneficiary information. We're going to want to know what name, if we're doing checkbook IRA, what LLC name you want to use, state of registration. And when we're doing those things, we're either going to pick your state of residency or state of investment. If you live in California and you're staring at a $800 plus annual cost for an LLC, you're probably not going to want a California LLC. But most states it's going to be anything from $20 to $100 a year. And you're going to fill out that 2-page application, get it back to us, along with a copy of a photo ID, color photo ID, and then your current account's most recent statement. If we're talking about IRAs, 401k plans, it's not necessary. But that's all we really need. And as I said, if a basic self-directed IRA is going to be sufficient for you, you don't need us at all. If you want us to hold your hand and establish the account, we can do that. But there's a number of self-directed custodians online that are going to be able to take care of you. And a lot of them have just online application processes, and you'll get that account established. So I'm going to go back to this slide real quick. So at the bottom, if you've got a basic self-directed IRA, to make an investment, you have to submit the investment to the trust company, and they're going to review the investment. Depending on the trust company, typically you're going to be required to submit certain investment documents. If you're buying into, let's say, an investment fund, they're going to want to see the offering agreement for the LLC. They want to see the offering memorandum, all that stuff. And then you're going to fill out a prohibited transaction form, the investment authorization form, and then they're going to review it. It's going to take 24 hours, maybe if it's expedited. I wouldn't bank on 24 hours, even expedited right now with the market the way it is. But it's going to take a few days for them to approve it. And after they approve it, they'll make the investment. So if you've got a basic account, you need an additional contingency of the purchase stating that it's going to be subject to the custodian's approval. If it's real estate, you don't want to have that offer made without their approval. And if it's a leveraged investment, you want to make sure that it's also going to have some type of loan provision in the purchase sale agreement about that non-recourse debt, because most purchase sale agreements have some type of loan provision as a contingency, but it's not going to talk about the non-recourse nature that's necessary for the IRA 401k to buy it. So you're going to add maybe a couple different contingencies if we're looking at making offers with a basic account, or typically any IRA. A checkbook IRA, if you're going to buy and invest regularly in property, or you're making investments that are time sensitive, you want to go buy REO property, bank owned properties, you want to go buy auction properties, you want to have immediacy of investment, your immediacy of negotiation, you're going to want to, if you've got an IRA, you're going to want a checkbook IRA. So all we're doing, we're still going to create the custodial account, but we're going to create that IRA specific limited liability company. So we're going to create the articles of organization, the IRA specific operating agreement, the federal tax ID number for that. And as we're creating that custodial or the custodial accounts, we're going to get the LLCs put together, and then hopefully the money's just going to move from custodian A to custodian B. And as it hits that account, the LLC will be established, all ready to go. The investment paperwork, we would have provided the trust company already. And all you would have done, as soon as we got the LLC together, you would have gone to the bank of your choice, opened an account, the LLC's name and federal tax ID number. The member of the LLC is the trust company for benefit of your IRA, or it could be the trust company for benefit of your traditional or Roth IRA. It could be you and your spouse's IRAs. Any combination of things could be members of that IRA LLC. So that, once again, the member is the trust company for benefit of your retirement account. It's a manager managed limited liability company. You're going to be the manager of the LLC. So, sometimes you're not. Certain trust companies won't allow you to be the manager. So, we have to look at what that trust company is going to allow, and that's going to be one of the factors that dictates which trust company you're working with. Since we're on that topic, just real quickly, I don't, in the self-directed world, I really don't like my clients working with trust companies that are charging based upon the value of the account. And the reason I don't like that is, in a Wall Street investment world, it's black and white what something's worth. In a self-directed world, it's not. If you buy a piece of property, what is that thing worth? And there's going to be definite differences of opinion in these situations. Highest best use is what you're going to look at. Typically, it's going to be what the buyer and seller agree to, but annually, you're going to need valuations, and I don't want to have my clients fighting with the trust company about the valuations on different assets just because they want more money. So the trust companies we use typically charge based upon the number of investments, not the value of your account. Just my personal position on this stuff. So in this situation, if you look at the left side, we've got IRAs, 401k plans, Roth IRAs, whatever might be there. We're going to create the custodial accounts that are necessary for each of those accounts. And then the trust company makes a single investment on behalf of each of those accounts. That's the membership interest of the LLC that you're the manager of. As soon as they make the investment in that account, your bank account, the LLC's name and EIN has the money. Now you want to go buy real estate, you just negotiate from the deal's inception between the seller and the IRA LLC, the checkbook IRA LLC. You want to do loans, whatever it might be. Everything's just going in and out of that limited liability company. The only interaction you've got with the trust company is your annual valuations of all cash and assets the LLC has, because they have no way of knowing what's in there. It's a wonderful investment vehicle. We talked about this. I'm running low on time. Basically, just got to be non-recourse. It's not attributable to your credit, your income, or anything else. And like I said, with an IRA, you're going to have tax exposure on the leverage. 401k plans, you do not. Solo 401k, I've been talking about this a little bit. So I love checkbook IRAs. They work great. I've got lots of happy clients with checkbook IRAs. But if you're self-employed, without employees, the solo 401k is going to be a wonderful opportunity for you, because you don't have to have a trust company, number one. Number two, you've got a bank account in the 401k plan's name and tax ID number, you as trustee or signer. So it just works exactly like a checkbook IRA, but you're not having any interaction with a trust company. You've got your max contributions are up in the high $50,000 range, so like a SEP IRA is going to be similar, but basically short of a defined benefit plan, they're going to allow you to plow the most money into these things. If you commit a prohibited transaction, you don't have all money in the account treated as distributed. You've only got the money involved with the indiscretion, which is a huge difference. You've got, you don't have the tax on leverage either. So once again, with an IRA, 50% loan to value asset, you're going to have tax exposure on half the income and half the gain on a sale. The 401k plan, you do not. So once again, I like that. A little bit more liberal in what you can buy. The only restriction is really collectibles. So they're attractive that way. And you can also borrow from your 401k plan, half of what's in it to a max of $50,000. So is there a downside? I don't really see it, other than the only downside I would say is that if you let's say your business starts growing and you start bringing employees on, then you would have to really find a third-party administrator, TPA, that's going to work with you in that thing. You've got potentially more liability, because you can't say, hey, as the boss, you can do these things with your plan, but your employees cannot. So, what's going to be best for you alone? If your spouse works with you, we can easily move your spouse's funds into the same plan too, which I really like that piece of it. So the reporting with a 401k is a $5,500 easy if it's in excess of $250,000 in balance in the account. If you've got under $250,000, there's really no reporting that's necessary. We haven't talked about costs at all to put these things together. A typical cost, let's say you've got a basic, self-directed IRA. If you want us to put it together for you, we're going to charge you a fee to establish the thing, and that might be about $500. All right. If you want to do it yourself online, maybe you can do it for $50, $75, whatever it might be. It depends trust company to trust company to do those things. And as I said, you can go online. If you're doing a basic account, we're going to tell you the trust company we typically use, and we're going to say, hey, go take a look at it. If you want to do it yourself, do it. If you want us to help you take care of it, then this is what we're going to charge. But a checkbook IRA, for example, a single member checkbook IRA, we charge a one-time fee of $2,300 to put it together. Your ongoing cost is going to be the trust company is going to be, figure around $400 a year for the trust company. You're going to be looking at state registration fees for the limited liability company. As I said, the extreme would be California at 800 and something, but a lot of them are anything from 20 to 100 annually. If that LLC is not in the state you live, you're going to need a registered agent. Certain trust companies are going to require a review of the LLC's activities, and that review could be done by your attorney, your accountant, or the organizer, which would be IRA Advantage. If you want us to do that, we charge $175 to do that. But so for a checkbook IRA, you're looking at somewhere between, let's say, $500 and $1,000 a year to keep that thing working. And a solo 401k, you're really looking at about $300 a year, at least in 2022 numbers. And that's just for restatements or amendments of the plan. You don't have to deal with all of that other stuff you do with the checkbook IRA. Few examples and we're done. All right. Now, if you've been in my classes before, you've seen these before. Sorry, I just like them. I think they really do a good job of exhibiting what's possible. These are all real transactions. This one was done during the last crash. So we had a builder developer came to us, said, hey, look, land is literally dirt is dirt cheap. The issue was he didn't have any idea when he was going to build on it, but he didn't want to be taking bank loans out and having all those carrying costs that were going to eat him up. So he thought, well, look, I want a land bank using my retirement account. Can I do that? And the answer is yes. The issue was going to be, well, gee, if his retirement account owns the property, if you think back on the prohibited transaction page, we talked about buying from or selling to a disqualified party constitutes prohibited transaction. So we had to deal with that. The other thing is you couldn't be working on a property owned by the retirement account. So what we did in this guy's situation is we created a second limited liability company, crammed his ownership down to 1/6. So put some vendors in place, some other parties that were not disqualified parties into the LLC. And what ended up happening is now we've got, anytime you wanted to build stuff out, the development entity would buy the property from the retirement entity, and they build it out. Now the retirement entity's got more money to go out and buy more land to be developed in the future. So we took what was potentially, or what would have been a prohibited transaction, got it taken care of by creating the different entities and creating that second entity with the taxpayer's ownership at a level that was low enough where that second entity was no longer a disqualified party. Therefore, we didn't have a prohibited transaction. I love this guy. He came into us originally, wanted to go out and buy a mobile home RV park. He kept asking me, hey, Leroy, you want to come in and talk to us? No, a really busy guy. He had a bunch of doors, a bunch of apartments. Really a neat guy. He was a physician at an institutional medical clinic, so clinics in big companies, and done very well. And so he was looking at a mobile RV park, and the broker was saying, well, hey, you might be able to use your IRA to do this. So that sparked the call to us. We started going through things, and so I kept asking, do you want me to send any information? And he was living in Palm Desert at the time, and he said, no, I'm going to head up to the Northwest, got a boat up there, and I'll just come see you on the way. I said, okay, that's fine, Leroy. Calls up the next day, hey, can I buy notes? And I said, yeah, sure, you can buy notes. So look at that 70 number. That 70K number was in Palm Desert, the last crash once again. So the first transaction he did, the first note he was doing was a first on a condo that pre-crash been a couple hundred K. The note was paying him 11%, 50% loan to value. And so, $35,000 loan paying him 11%, very happy guy. And, if you look at that transaction, hey, you almost hope the person defaults, right? So ultimately, a lot of people start off dipping their toe in the water, end up moving a lot of funds over time. So he started off with a $35,000 investment. He ended up moving several $1 million through us into his retirement accounts. And the best deal I think I ever saw him do was a deal with a wind power plant. They needed $1 million, and it was like a $20 million project, and it was paying him 19%. And he was just, rubbing his palms together, hoping they were to default. But terrible tease, toilets, trash, tenants, turnover, didn't want to deal with it. So that's where he went with the paper. And I just love notes in these things. So we've got a couple firms that actually, we have clients that invest in those hard money lenders all the time, and they've been very happy in that space. So once again, never anything but a first, never for anything more than you'd be happy owning the asset for. So this is a tough one. Once again, last crash, the guy came in losing a property. It was with Washington Mutual. Anybody remember WAMU? Anyway, the bank goes away, the loan goes away, got a major problem. So he was not happy about the opportunity or the potential of losing $1.2 million. So he had a $3 million property, $1.2 million lien on it. He calls up, says, hey, can I take Dad's IRA, pay this thing off? And the answer straight up would be no, you can't do that, prohibited transaction. What we did is we created a new limited liability company. Junior put the property into it, received a membership interest attributable to the equity in the property, so $1.8 million interest. By the way, you need somebody to provide a professional opinion of value there. You can't just miraculously say, gee, the thing's worth $4 million. You got to make sure you can rationalize those numbers, make sure you and your tax people are okay with it. But in this situation, $1.8 million was what his equity was. So when he contributed the property to the LLC, he got membership interest attributable to $1.8 million. Same time that was happening, we created checkbook IRA for his dad. His dad's checkbook IRA made an investment in the LLC, which now owned the property and had the cash to pay the loan off. So that's how we got around it, and that worked beautifully. And hopefully I don't have people coming to us with the same type of situation going forward, but this was a solution that worked very well for the people in this situation. Just simple investment, making an investment with a checkbook IRA. So I want to stress, don't come to us when you're, after you've made a deposit, earnest money deposit, struck up the deal. Make sure that you've got this thing set up before you go to make the offer. So this guy called up, asked the questions, got the checkbook IRA established, ends up going out, taking the checkbook IRA, buying the multifamily project, and it works very well. Once again, the cash flow off that project is not the individuals, it is the retirement account. So all the cash flow off that, any income goes in the checkbook IRA LLC, any expenses paid out of that LLC, and the only way you're going to have a personal benefit to that IRA LLC's activities is by taking distributions, right? Finally, last example. This is not an IRA deal. It is remember earlier I talked about rollover business startups. So this is a rollover business startup. What happened is we had a couple, older retired couple came to us, said, look, we'd like to take each of our respective IRAs and go out and buy this mobile home RV park. Can we do that? And our first thought was, yeah, we'll just do a multi-member checkbook IRA. So once again, if you look back at that bubble chart, that IRA LLC had his IRA as a member, or technically speaking, the trust company for benefit of his IRA and the trust company for benefit of her IRA, those two different members of the LLC. The manager was he and his wife, manager managed LLC once again. And that's how we would have made the investment if it was just an investment for them. Well, they threw us a curveball because they go, gee, we want to live there and we want to be paid as the on-site managers. Well, we can't do that IRA because both those things constitute prohibited transactions. So we shifted gears in the rollover business startup. So instead of doing the IRA and the LLC, we shifted gears into a 401k plan and a C corporation. So the money flows from wherever it is. Each, in this case, both their IRAs into a new 401k plan. I want to caution you, we cannot move Roth IRA money or beneficiary IRA money into a 401k plan. Beneficiary IRA is inherited IRA money. So this was all regular IRA, and we created the 401k plan. The money moved from the plan, or the IRAs into the plan. We create the C corporation. The plan then buys the corporation. We require our investors to also be shareholders of the corporation. And then that corporation bought the park. They got an investment, they got a job, they got a place to live, all with that one transaction, which I just love. I love that story, and it worked very well for them. When using retirement accounts for purchases, it's essential to remember the item purchased must be an investment and that no personal benefit can be realized until future IRA distributions are taken. Plan ahead. It takes 2 to 4 weeks to put the thing together. I'm not going to say 2 weeks these days. It's probably going to be a month to get it done. You can purchase all types of property with an IRA, SEP IRA, Roth IRA. You can purchase with family members or friends. You cannot purchase from or for them. Your IRA cannot sell to you or any other disqualified party. You can use an IRA to buy property with a mortgage. Negotiate from the deal's inception the IRA or IRA LLC's name. Do not overextend. Plan on keeping a nice cushion of reserves. Real estate is real investment. Now, the reason I made the comment about the reserves is once in a while you buy something and some cost sneaks up on you. Make sure you have enough money in the account to make the purchase and covering any carrying costs until you got money built up. If you're doing a non-recourse loan, you want to take a look at what those might be. Type in myiralender.com or iralending.com. There's a couple of banks that specialize in this stuff. They're typically going to see about 15% reserves just in case. All right. That's it. Now I see questions over there. We're out of time, so I'm going to address those things all written back to you. Apologize, didn't have time to get to you. We're 7 minutes over as it is, but take a look at our sites. If you've got questions, the best thing to do, really, they say YouTube's sort of the ultimate search engine these days, but if you got questions on different aspects of 1031 or IRA, or even a variety of other things, take a look at our YouTube channels. I think you're going to be pleasantly surprised at what's up there. If you've got a question that we don't address, please let us know, and we'll try to create some content to answer those situations. But thank you very, very much for joining us today. Once again, David Moore, IRA Advantage, IRAadvantage.com or .net. If you've got questions, reach out to cmoore at IRAadvantage.net. Once again, CMOORE at IRAadvantage.net. If you're a broker needing credit, she can also help you with that. David Moore, thank you very much, and all my best. Best of health to you, and have a great day. Take care. Bye-bye.